Jeff is with us once again to speak to the Recession Risk Dashboard, to include some important changes that he'll go into, but more importantly, to give you some added commentary on all what this could or does mean for the markets. Commentary that we hope you find value in and can take back to your practice and client base. Very quickly, for those of you that are simply dialed in over the phone and without access to the actual webcast, you can listen in and review the dashboard by logging on to www.legmason.com/AOR. www.legmason.com/AOR. With that, Jeff, it is wonderful to have you here again, and we very much look forward to your comments today.
Great. Thank you, Brian, and good afternoon, everybody. Thank you so much for dialing the call here today, and I think we're at a very important turning point of the market. Obviously, the volatility has been uncomfortable for both you and your clients over the last couple of weeks, and the natural question is to ask whether or not this volatility is going to continue until we get some visibility with coronavirus, and we think that is going to absolutely be the case. Now, if you look at the correction that we've experienced over the last 2 weeks, that was the fastest 10% decline that we've seen in the S&P 500 from a record high in the history of the markets, and this downturn couldn't come at a worse moment. You have already some depressing growth coming into the first quarter because of the Boeing planned shutdown of production of the 737 MAX. We estimate that that's going to shave about 0.5% off of first quarter GDP, and unfortunately, because of the issues associated with Boeing, that's going to bleed into the back half of the year, and we think that's going to shave off another 0.3% of GDP next quarter. Also, the one area that you've seen some issues here is corporate profits, and this is something that we've talked about in the Anatomy of Recession over the last couple of quarters. Corporate profits have been under siege in the U.S. economy, and the S&P 500 was flirting with an earnings recession, and margins were coming in a little bit better than expected, but you're seeing some tougher margins across every company in the U.S. Now, more importantly, with the dashboard, we don't look at the S&P 500 for profit margins. We look at NIFA profit margins. This looks at micro, small, mid, large, and mega cap companies. It's a much better barometer of what's going on in the U.S. economy. And if you look on the chart on the right-hand side there, you can see that red line, that red dotted line is where we thought NIFA profit margins were last year. But after a $200 billion revision in July, which is a huge revision outside of a recession, that blue line below it shows you where margins have been for the U.S. economy, and they've been roughly flat since 2016. Now, if you look over to the left-hand side, you can see that most Americans work in a company that has less than 1,000 employees. This is important because most of the margin pressure you've seen has been in micro and small cap companies because of a tight labor market and the inability to pass tariffs through to their end clients. Now, if you think about the Russell 2000, most of us think of that as a small cap company, but your average Russell 2000 company employs close to 3,700 people, which is 4 times the size of where most Americans work. So unfortunately, because you're seeing issues with profit margins, this downdraft of growth that we're going to see may ultimately lead to hours being cut back for employees, and you're certainly seeing that in the manufacturing sector. But if cutting back hours does not do the trick to help margins, they will resort to layoffs. And given the employment number that we saw today, it's clearly not the case quite in the U.S. economy, but if growth continues to slow, this could potentially manifest into a bigger issue and a potential recession. Now, the key reason why the markets are freaking out because of coronavirus is because of what's happened in China. If you looked at China's official PMI data that came out last Friday, PMI came in at 35.7. The expectation for consensus was 45, so it missed consensus by a wide margin. And to put 35.7 into consideration, that's worse than what we saw during the great financial crisis. This looks at, the official PMI looks at your large cap companies, your state-owned enterprises, but we also got the Caxton manufacturing PMI data as well, which looks at small and medium-sized businesses, and that came in at a 26.5, which is a record low since that data series has been out there. So these are data points that came in well below consensus expectations. Furthermore, if you look at the drop of PMI that we saw during the great financial crisis in 08, it dropped about 13 points. That shaved about 9 percentage points off of GDP during that time frame. You think about the size decline that we've seen here with manufacturing PMI, that argues that China's real GDP slowed by at least 10 percentage points in the over February, which could translate to a negative 5% annualized first quarter print if they're being honest with the numbers. Again, I don't think leadership will come out with that negative print, but that just shows you how drastic the slowdown has been. And the markets are rightfully trying to assess whether that same type of reaction is going to happen to other areas of the world, and more specifically here in the U.S. Now, if you think about viruses, generally speaking, viruses are buying events. If you look at the Ebola virus, avian flu, MERS, swine flu, SARS, West Nile, the avian flu, typically you see a sharp sell-off when those outbreaks occur, and 6 months later the markets are up. If you think about SARS and Zika, for example, the index fell about 13% during each of those instances, only to move on to meet record highs. But we're dealing with a little bit of a different animal here with the coronavirus, because when you had all those other diseases, it was very clear that you were sick and contagious. With the coronavirus, a lot of the carriers that have it are asymptomatic, and they're carriers of that virus from anywhere from 2 to 10 days. This is a key reason why it's undetectable, or it has gone undetected through large swaths of the world. More importantly, though, the R0 score number for the coronavirus is close to 3, which means that for every person that gets the coronavirus, they affect 3 other individuals. If you compare that to the average flu's R0 is about 1.4, which means coronavirus is 2 to 2.5 times more contagious than the average flu. But most importantly, if you look at the mortality rates, they expect the mortality rates to be closer to 2% for coronavirus, which is about 10 times deadlier than the overall flu. Now, thinking about the mortality rates, though, it's heavily skewed toward older individuals with pre-existing conditions. If you think about China specifically, the individuals in China suffer from a combination of poor air quality because of higher pollution, but also higher smoking rates. And if you look at Hubei province, that actually was the tobacco road of China, believe it or not. And China once ordered the people of Hubei province to smoke more about 10 years ago. So it's unclear whether or not the mortality rates are higher in China, and they're likely to be lower in the rest of the world because of that particular issue. More importantly, though, if you look at South Korea, the case fatality rates are much lower. Right now they're coming in at about 0.6%, whereas in China, the mortality rates, their fatality rates, were closer to 3.7%. Now, I think that large difference is attributed to the higher smoking rates and the higher pollution rates of China, but also it can be explained by missed cases in China. South Korea has been very aggressive with their testing efforts, so maybe more people had gotten infected in China but never got tested to bring that mortality rate down. Also, there's better healthcare provision in South Korea, and South Korea had some warning and was able to respond more quickly than what you saw with the initial outbreak in China. So hopefully, when this is all said and done, the fatality rate will be closer to 1%. But right now, the official rate is actually much higher. And I do think that is a little bit misleading, because most people that have coronavirus probably have not been tested to be included in those official numbers. Now, thinking about it from the U.S.'s perspective, the first coronavirus came in Washington State from someone who had been in Wuhan, China, and they sought medical treatment here on January 19th. They landed back from China on January 15th. If you think about that, that means that the first coronavirus case was in the U.S. about a month before people even started about talking about it leaving Chinese borders. What that means is it's had an opportunity to spread into the U.S. here undetected for over a month and a half. So if you think about the outbreaks that you've seen across the West Coast, you've seen it in Chicago, you've seen it here in New York, I think it's going to be very hard to contain the virus at this point, because you can't quarantine everyone, because it's been out there spreading for a month and a half without being checked. Also, the U.S. has some of the lowest testing capabilities in the world right now, which can result in that hidden spread further. So the reason why I mention that is because it could hurt economic activity here in the U.S. from a combined effect of both a supply-side shock and a demand shock. Now, supply-side shock happens because the Chinese factories are going unmanned right now. There's no production, manufacturing activity, and supply-side shocks are actually very hard to counteract, right? Fed policy isn't very helpful with the supply-side shock. But you're also seeing a downward demand shock as well through the confidence channels. Now, if you do start to see school closures, you see travel restrictions, you see people that are unwilling to go out in public places and spend money, entertainment activities are going to start to slip here. That's how you can see the economic growth slow dramatically, not just from that supply side shock, but from the demand side as well. Now, also, if you think about how this has potentially worked its way through into the U.S., we're looking at a lot of data here from a consumer standpoint, and it does appear that people are stocking up at warehouse clubs and grocery stores, and you've seen sharp drop in travel-related spend as well as slippage in entertainment activities as well. So this is already starting to affect consumer behavior. Now, one of the reasons why I think the Fed stepped into the markets here is to give confidence back to financial markets. And let's not forget that in the sell-off that we saw in the fourth quarter of 2018, the lagged effects of that sell-off caused consumer confidence to come down dramatically in the beginning parts of 2019. So if the Fed steps in and can stabilize financial markets through lower rates and the ability to stand in and deliver liquidity that's needed, I think that is absolutely an appropriate policy stance from the Fed in interacting with the coronaviruses and the effect that it's going to have on the U.S. economy. Again, Fed action can't really help on supply-side shocks, but it can help on demand-side shocks through confidence. Now, we had expected a 50 basis point rate cut from the Fed in the upcoming meeting. Obviously, they delivered an intra-meeting cut of 50 basis points. I think that we're going to get another 50 basis points in cuts over the next month and a half. I think they're going to do another 25 basis point cut in March 18th, followed by another 25 basis point cut in April. But it's important to note that traditionally when you've had intra-meeting Fed cuts, the Fed has usually gone with a big policy response. 4 out of the last 5 times that you've had an intra-meeting cut, the Fed has followed up with a 50 basis point cut in the following meeting. I don't think that that's the base case, but if coronavirus continues to spiral out from here and it has having a negative effect on economic growth, it wouldn't be a surprise to me if the Fed continues with a shock and awe policy to keep the economy in its equilibrium. Now, there's been some people who say that the Fed is overreacting and they're placating to market expectations, but I don't think that's the case at all, because when you have a situation like this, you want to act very confidently in the front end with a shock and awe. That's what the 50 basis point cut was for, and that's going to be followed up by 25 basis point cuts as more information comes to try to counteract that weakness. It's like you're driving a car at 65 miles per hour. If you run into a steep incline, you're going to have to hit the gas pedal in order to prevent the car from slowing down below 65 miles per hour. And the coronavirus is going to cause the U.S. economy to slow down, so why not press on that gas pedal and give liquidity to financial markets, to the economy when it's needed. Another analogy that I like to use is it's saying if you're going to get a gunshot wound in 2 days, I'd rather start taking antibiotics a couple of days prior before that gunshot wound. And let's not forget, Fed policy works with a lag, so it's important that the Fed is acting now preemptively. And there's nothing to say that the Fed, as soon as things get through with the coronavirus, they can't bring the rate hikes back up to normalize policy as soon as this is in its rear view. The other thing that I've been talking about here is that I think the easiest way for the Fed to work with coronavirus is to maybe start an asset purchase program and say something along the lines of, we'll buy a certain amount of treasuries every month until we see the 6 weeks of sequential declines in new cases or inflation expectations start to surge past 2.5% or 3%. This is a way that the Fed is prevented from having to do something every time we get a down day in the market, which is a horrible way to conduct policy. But nonetheless, with inflation dormant right now, recession risk rising, I think the Fed has done the right thing in providing liquidity to the markets. Now, trying to think of a situation that's similar to where we are today, 2 time frames come to mind, and that's going to be the 1990 recession and also the 1974 oil embargo recession as well. Both of these were supply shocks that ultimately caused a recession. So think about 1990. The economy was weakened by tighter monetary policy and the savings and loan crisis. It only took one shock to end that expansion, which was going into the war with Iraq and that associated spike of oil prices that went along with that. Now, even though you think of that as a purely supply-side shock, household spending started to retreat and it tipped the economy into the recession. Similarly thing happened in 1974 when oil prices spiked up over 400%. So again, unfortunately, we think recession risks are rising here. And if you think about the dashboard specifically, we went yellow back in July of 2019, and traditionally when we've gone yellow, it's taken 6 to 9 months to go to a red signal, which is a recession, or a green signal, which is an expansion. We're really hoping that the first quarter we are going to go back to green, which signaled expansion. And quite frankly, at the very beginning of February, we were in borderline green territory because you were seeing acceleration of the data underneath the surface because of the actions that the Fed did in 2019. However, given the carnage that we saw in financial markets in the month of February, we are now back firmly in yellow territory, actually closer to red than yellow, quite frankly, at this given moment. So if you're looking at the dashboard, we had 4 changes in the month of March, 2 upgrades and 2 downgrades. The 2 upgrades were money supply and commodities, and both of those went from yellow to green, and quite frankly, with the weakness in global growth that we're seeing, I wouldn't be surprised if commodities will go back to a yellow signal when this slowdown and this hit to growth filters through to global markets. But at the moment, it's certainly a green color. And then we had 2 downgrades, which is job sentiment went from green to yellow, and we also had profit margins go from yellow to red. But overall, unfortunately, we're back to an overall yellow signal in the dashboard, and we do believe that the odds of a recession are still at 50-50. We're not out of the woods quite yet. Now, the areas that we've seen that were hit from the coronavirus here recently has been ISM new orders, credit spreads, and the yield curve. Looking out a little bit further, we think it could hurt retail sales, could also hurt commodities and truck shipments as well. So even though the dashboard isn't specifically designed to pick up an exogenous event like the coronavirus, we think weaker economic growth that will be associated with the slowdown of economic activity, the closures of schools, people not going out and spending like they traditionally have, will be picked up through the dashboard. And I want to just hammer home on this slide here that we've been saying this for quite some time, that we're not going to know what the ultimate catalyst is going to be for the recession. The recession catalyst is always going to be something different. In 2007, it obviously was the bursting of the housing bubble. In 2000, it was the bursting of the dot-com bubble. 1990, you can say it was the spike in oil prices or the lagged effects from the savings and loan crisis. So the catalyst is always going to be different, but the economy, when it's in a vulnerable state, that catalyst is enough to push us into a recession. If you think back to 2015 and 16, the economy was actually in a pretty good state at that moment, but oil went from $100 a barrel down to $30 a barrel in a short period of time. That caused a pretty big dislocation here in U.S. production, but also caused a slowdown in U.S. economic growth. And if we were further along in the economic cycle, we were in a more vulnerable state with the U.S. economy, I firmly believe that that would have been a recession, and the catalyst would have been the great oil price decline of 2015. Now, thinking about that today, is coronavirus going to be that catalyst? It's too early to tell because we don't know what the U.S. response is going to be. We don't know how fast the coronavirus is going to spread through the U.S., but I will say this, is that I do think that the markets will continue to be choppy with a downward bias until there's visibility on how far this coronavirus is going to last and what the ultimate response is going to be. Now, one thing I want to show here is that we've been talking about this, is that the last number of times that the Fed has cut rates, 3 times, you've had 2 that ended up in a soft landing, which were 96 and 98. You had 2 of them that ended up in a recession, which is 2001 and 2007. Now, the key here is that at the 3 months after that third rate cut, the markets are generally positive. So the markets are going to always think that the Fed has saved the day, but it's only 6 months after that slowdown where you can tell whether or not we're going into a recession or if it is a genuine slowdown. And the 6 months following the soft landings, the markets were positive in both of those incidents. In the 6 months following the recession, the markets were substantially negative. Now, it may feel like forever ago that the Fed did their third rate cut, but they did their third rate cut on October 30th of last year. You fast forward where 6 months is going to be, that's going to be the end of April. And as of today, given the market sell-off that we've seen, the markets are actually down 3.5% since that third rate cut. So again, that argues that the odds of recession here are rising in the near term. Now, the one thing I also want to show you here is that volatility is going to be higher. And we have a bunch of slides in the longer anatomy of a recession deck that are excellent to use with your clients. And for those of you that are dialing in on the phone that may not see the WebEx, we're on slide 55, and we're going to go through the next 4 slides. And if you look at slide 56, we've been saying that volatility is going to be higher for the rest of this cycle, whether it's a slowdown akin to 95 or 98, or it's an outright recession. The reason being is that the yield curve actually leads volatility by 3 years, meaning today, if the yield curve flattens, 3 years from now, volatility will tend to be higher. This is a relationship that's been going on since volatility was a thing in the early 1990s. Now, if you look over the last 3 years, the yield curve has been flattening relentlessly, which means that volatility, unfortunately, is going to be higher for this cycle, whether or not this is a slowdown or this is an outright recession. But you want to stay invested, right? And this is where this is a great slide to use with your clients, because volatility doesn't necessarily equal a financial loss until you sell. So this looks at the returns of the S&P 500 since 1983, and what the median annualized total return was 15.1% per year. But in order to get that 15.1% return, you had to endure almost a 10% intra-year decline in order to get that. So unfortunately, with the higher returns that you get from equities, you're going to have to deal with higher volatility that goes along with it. But you don't want to cherry pick when you're in or out of the markets, because being out of the markets for some big up days can drastically reduce your long-term returns. Now, this looks at every decade's returns since the 1930s. If you look at the very bottom of this chart, you can see that the average price return that you typically get in the decade is 114% if you exclude just 10 days in that decade. So the 10 best days, 10 days out of 3,600 days, your price return goes from 114% all the way down to 44%. So you've lost effectively 70% on your decade return by missing those big days. And quite frankly, those big days happen in periods of volatility like we're seeing today. So you want to make sure that if you're a long-term investor and you've talked about a plan for your financial plan for the next 5, 10, 15, 20 years, you want to be invested during these volatile times, because if you try to cherry pick, your odds of having lower returns are going to be much higher. The other thing I want to share with you here is the areas that typically do well when you see periods of market volatility. Now, this is the last 7 major market drawdowns that we've seen, so drawdowns of 15% or greater, and we're looking at the sector performance of the S&P 500. Now, on the left, we're looking at the relative performance versus the market, and you can see that financials and IT typically do the worst during market sell-offs, but at the bottom there, you can see that consumer staples, utilities, and healthcare are the areas that you want to be invested in. The relative performance on average has outperformed with healthcare, consumer staples by 20% during these drawdowns, 14% with utilities, and then healthcare at 12%. Not surprisingly, if you look on the right-hand side, you can see the hit rate. How many times did you outperform out of those 7 time frames? And the same 3 that had the best relative performance showed the best hit rate at 100% for staples, utilities, and healthcare as well. So if you're looking to get a little bit more defensive in your portfolios, if you do any sector-level analysis, these are the areas that you want to look at. And these are certainly areas that our PMs at ClearBridge are looking at in order to bulletproof their portfolio for some choppier economic and market data. But the last thing I want to share with you is something that may seem counterintuitive. This looks at all the 5% plus drawdowns that we've had in the market since 2004. We've had over 30 of them, and you can see the areas of the style blocks that have given you the best downside protection. This may come as a surprise to a lot of people, but you can see that large cap blend and large cap growth had the best average relative performance, so they protected the best from an overall negative standpoint. Small cap value, small cap blend, and mid cap value did the worst on a relative basis. But most importantly, if you look at the hit rate of large cap blend, you outperformed 83% of the time, and if you look at your hit rate of large cap growth, you outperformed 75% of the time, and no other area of that style box outperformed over 42%. So if you do believe that this volatility is going to be with us, you think there's going to be some sustained pressure on equity markets, these are going to be the areas that you're going to want to look to bulletproof your portfolio. You're going to want to move up in market cap, but also move up to blend and also growth as well. And let's not forget, with large cap blend, you have a lot of dividend growers and a lot of dividend payers. And in downward markets, dividends are your only source of positive market returns. But I do think overall that the coronavirus is a known unknown at this given point. I think the disruption is likely going to be very big here in the U.S. I think we're on the precipice of seeing schools shut down, people change their habits on how they act, how they spend, and more importantly, businesses which had gotten a boost in the arm because of the trade détente that we finally got in January. I think businesses are going to get less confident going forward. They're not going to move forward with their CapEx plans, and more importantly, they may not move forward and to go and hire that marginal employee, even though one of the biggest issues facing small business owners right now is finding an employee that can fill the job. Now, With that, maybe I just want to slide over to one more confidence slide here just to show you what we're looking at. It's slide 53 in the deck. It's going to show you that usually at the end of an economic cycle, you have a very large confidence gap. Confidence between businesses and consumers. It's not the fact that you have a large gap that it's a potential issue. It's when that gap starts to close is when it starts to become a problem, and you know you're on the precipice of a recession. It's not that businesses get more optimistic, and they're usually pretty pessimistic at the end of an economic cycle. It's that consumers get less optimistic. And the consumer confidence surveys that we've seen here, they've all near record highs at the given moment. But if we do start to see some cracks with consumer confidence, and consumer confidence always drops ahead of a recession, we think that recession risks are going to start to rise. So with that, that's all my prepared comments. I'll maybe turn it back over to Brian.
So with prior calls, we've always had polling questions, as you know, Jeff. Today we're just doing two. Jeff, that was a mouthful. I'm seeing you, and I'm like, wow, I hope you can get some oxygen in between next comments. But, you not only did you say it once, you said it twice, that it looks like odds are rising that, a recession could come. So like the last call and the call before that, one of the first polling questions, and if it wasn't first, it was one of them, was, do we think that the U.S. is heading into the next recession? We asked that in January. I'll tell you those numbers in just a second, but the difference this time is the question is, will the coronavirus be the catalyst for the next U.S. recession? So we inserted a very important word into that question. The polls are in, and Jeff, as pretty much predicted yesterday when we had our pre-call, it looks like roughly 77% of you said no, and 33% of you said yes.
67 or 77?
Oh, well, that's what's written here. What do we have? Is it changed? 67? 67 to 33. The last time we asked that question in January, it was 90% no and 10% yes. So a slightly different commentary since Jan.
I got to say, I think I said 67. I said 2/3 would say no recession, 1/3 recession.
So right on. Hold on. All right. So as always, one of the beauties of this call is that we go to the studio audience and we come with questions. So why don't we start with the first question? In some of your very first opening comments, you mentioned China as it relates to the coronavirus, and all eyes were originally there. Now, obviously, they're moving near and dear to our hearts here domestically. But the first question is, can we trust the Chinese data? Is the outbreak really under control? Are they going back to work, et cetera?
Well, that's a great question. I take any piece of Chinese data with a healthy amount of skepticism. Obviously, their GDP rate has not been 6% on the button for the last couple of years. I actually have been reading a number of different articles here that actually show or say that Chinese local entities are faking work resumption to meet targets. So there's an investigation done by the Caxton that shows that local companies and officials are fraudulently boosting electricity consumption and other metrics in order to meet tough new back-to-work targets. So I think that you look at pollution out of China that has been increasing, and Bloomberg did an article on that very recently. But I do think that there's an element here that maybe all is not right. Maybe they're not going back to work as quickly as is commonly being reported. One other thing that I'll mention is that the Chinese leadership will be judged on the effectiveness of being able to contain the coronavirus, and I would imagine that they'll err on the side of caution, keeping quarantines in place further and longer just to make sure that they can have it under control before going back fully to work. So no, I don't believe the actual numbers. I do believe that there is a bit of an air pocket there. And the other thing I'll mention is that if you look at the official numbers in Shanghai or Beijing, they only have a couple hundred of numbers of cases of coronavirus. I think those numbers are very drastically understated, considering the outbreaks that you're seeing here in the U.S., over in Italy, South Korea, what have you. But I do believe China is going to get back to work slower. I think that's going to continue to impact supply chains, and it's going to be a drag on growth into March and into April until they can fully quarantine and feel confident they have that virus under control.
One of the words I used in the opening was uncertainty, which obviously leads to volatility. It can lead to what we're facing right now. And, a lot of the things that I've read talk about, uncertainty may never dissipate until, whether it's domestically or internationally, we can really truly have faith not only in the data that you just talked about, but certainly policymakers and above all else, leaders. So both domestically and internationally, globally, that's what people are looking to. The second question is, do you see fiscal stimulus coming into the U.S.?
Well, they just passed a package in Congress that was about $8 billion, but that was much smaller than what you saw in Hurricane Katrina, 9/11. So that's really a drop in the bucket, all things considered. President Trump has called on the Democrats to pass a one-year payroll tax as a potential response to slower economic growth. I think the odds of any major fiscal policy change is probably about 1 in 4. But it would rise if the economic situation deteriorated significantly. But if you do get a fiscal policy response, it's not a reason to be bullish on equities, because Congress is only going to act if, again, economic conditions worsen and the markets will start to price in a recession at that given point. So if you think about what Trump has suggested, if you have a one-time payroll tax cut, shave 2 percentage points off of payroll tax from 6.2 to 4.2, that would be a boost of around 0.6 percentage points to GDP. The advantage of this is that it's easy to administer. It pushes tax relief out the door immediately through lower withholdings. The only downside is that it adds to the deficits. Democrats would prefer something more along the lines of the Making It Work credit that happened in 2009 and 2010. But ultimately, I think the biggest obstacle to fiscal policy is not only the differences on what the policy response would be, which we just talked about, but also the fact that stimulus would boost the economy before the presidential elections, and that could potentially help reelect President Trump. And obviously the Democrats would be reluctant to do that. And as I've shown in previous webcasts, you can see here that the only 3 presidents in the post-World War II era that have not gotten reelected for a second term were H.W. Bush, Carter, and Ford. Those were the only 3 presidents that had a recession within 2 years of the election. They're the only 3 presidents that saw a material rise in the unemployment rate the year of the election. So I know there's a lot of talk of fiscal stimulus. You're seeing it in South Korea. You've certainly seen it in China. The Italians are coming out with some fiscal stimulus. Ultimately, I think that the stimulus response from the fiscal side is going to be relatively muted unless it turns out to be much worse than what's currently anticipated.
Thanks, Jeff. So let's go actually back to dashboard talk for just a second. With the obvious flight to treasuries, how does this affect any of the dashboard data?
Well, the Treasury market specifically doesn't affect any of the data except for maybe the yield curve and also credit spreads as well. But there is a lot of information value that we've seen in the recent drop. That means growth and inflation expectations are both coming down dramatically. Now, if this was just a pure supply side shock, you would see a hit to growth, but inflation would generally rise, and the net effect on the 10-year Treasury would be 0, right? Then you've traditionally seen that with other supply side shocks. But because the 10-year Treasury has dropped so dramatically, it's not only growth that's coming down, but it's inflation that's coming down, which tells you, again, it's a supply side shock, but it's also a demand side shock as well. Also, the thing that I want to really note here is that the velocity and the decomposition of the drop is very similar to the ones that we've seen headed into recessions. If you look at Wednesday's market action, Wednesday the markets were up 4 to 5%, depending on which market you were looking at, and yields continued to drop that day. And it really tells you that the bond markets aren't buying this as a hiccup or a temporary phenomena. Also, I think there is some information value with the breaking of 1% on the 10-year Treasury. That's an important psychological barrier. It tells people and banks, whether it's true or not, that the economy is not on sound footing, and it may start to alter spending or lending patterns. And we also had a chart in Anatomy of Recession a couple of quarters ago that said that it showed you that the 10-year Treasury was not controlled by global growth or weaker global growth, but actually manufacturing PMI here in the U.S. Essentially, they're mirror images of one another since 2011. And with the recent drop of the 10-year Treasury, that suggests that even though manufacturing PMI came in better than my expectations this month, that's likely going to fall in the coming months, and that U.S. growth is going to fall and flirt with a recession. So, directly the dashboard picking up the 10-year Treasury, not so much, but, I think the 10-year Treasury can tell a lot about ultimately where the destination of the economy is going to go.
Yesterday afternoon, I saw a stat that said that the S&P 500 dividend yield just crossed above the 30-year by more than 10 basis points, something we haven't seen since 2008, and before that, the 1950s. Interesting. So, well, go ahead.
No, I was just going to say, we have a chart for everything. If you've never seen this longer anatomy of a recession deck, that shows you that the 10-year Treasury yield, and this was on December 31st, 36% of S&P 500 stocks had a dividend yield higher than the 30-year Treasury. I haven't updated this chart in a couple of months, but I would imagine that number is probably closer to 60%, which means dividends are a pretty attractive option for those that are looking for income.
Well, it goes back to one of your final comments about dividend growers and dividend payers, being maybe one of the only sources of income right now. So the next question goes back to really the polling question about, the recession. So if this truly does prove to be recessionary, how bad of a recession might we expect?
I think it's early days with the coronavirus to see how disruptive it's going to be. So, I say this with the expectation that it's not going to be very disruptive. You're not going to see quarantines like we saw in China. But I will say that there hasn't been the typical buildup of leverage that you've seen in prior cycles. Usually you'll see buildup of leverage with the household balance sheets or the corporate balance sheets, and that will create a bubble. When that bubble bursts, it brings down the economy along with it. You can see since the last 7 recessions that we've had, you've typically seen a buildup of debt of around 15% of GDP. Today, over the last 5 years, consumers have delevered as a percent of GDP, and even though corporations have brought on some debt, the total increase of leverage is around 2%. So I think that it's probably going to be a shallow recession because the economy isn't overextended. I think it could be a shallow recession because of when coronavirus is starting to get better at the margin, people will go back out and spend, and they'll do the things that they did previously. So I would imagine a shallow recession. I think the markets will probably be down about 25 or 30%. It's not going to be the 50+% drawdowns that you've seen in the last 2 recessions, but more importantly is what has changed here over the last couple of years is the speed of the market price action when pricing in these downturns. You think about the fourth quarter of 2018, the markets lost 20% in 3 months. That is a very, very fast drawdown. You think about the first quarter of 18 with the short vol unwind. The markets lost 10% in 2 weeks, and most recently it lost 12% in about 7 trading days. So I think it's probably going to be fast and furious with the drawdown if this is a recession. But since it's going to be a shallow recession and not a very long recession, I think the bounce back will be very quick as well. But your average recession that you see in the U.S. is around a year. I would imagine if this turns out to be recessionary, this will probably be in that 6 to 9 month category.
Jeff, look, you have the dashboard with the indicators, but I think we can also assume that you look at other data points, maybe other research. So maybe outside of the dashboard, what macro data are you following to see whether, again, I keep inserting this word, the coronavirus effects are potentially dissipating?
Yeah, so obviously the dashboard is going to be our compass that tells us where true north is, but I'm watching a couple of other areas, copper, gold, the 10-year Treasury, which we obviously just talked about. I'd also put spreads in there, and then also chemical pricing. If you think about copper, good news, if you look at copper, it's a proxy for global industrial demand and Chinese economic momentum. It's stabilized here after a pretty initial large drop, so that may be signs that things are getting better at the margin at China. Unfortunately, gold continues to rise. We just talked about the 10-year Treasury making new lows. And then also spreads have started to blow out, and they look to be continuing to blow out here in the near term. And then also chemical pricing has been relatively firm, but if you see chemical pricing start to come down, that's going to mean weakness from the earliest part of the supply chain, and that will generally signal a recession or weaker economic growth looking out 3 to 6 months past that. And it's a key reason why chemicals is the biggest component of our hybrid commodity index that we put together on the ClearBridge Recession dashboard.
As I said earlier, a lot of people are going to be looking to leaders domestically, globally, policymakers, et cetera, for confidence building. And so, but there's more, right? There's business people, there's investors, but more importantly, there might be consumers that have to have greater confidence in all said leaders before we might see some sort of a turn. So the next question is around consumer sentiment. How has, in your view, how has it been measured during this downturn, and what will you be monitoring along the way?
In the dashboard itself, we do have a measure of consumer confidence. It's called the Job Sentiment Indicator. That looks at, from the Conference Board survey, how many people are saying jobs are easy to find versus hard to get. Usually at the very end of an economic cycle heading into a recession, jobs are harder to find and less easy to get. Unfortunately, we've seen an inflection down here in the month of February from green to yellow. And as we get closer to red, and I'm not sure how the labor markets are going to respond to coronavirus. Obviously, we got the February March non-farm payrolls data this morning. It rose up 273,000. That was a very, very strong number. I was very happy with it. But again, that was yesterday's data. That doesn't take into consideration what's going to happen with coronavirus. But we're monitoring sentiment from the consumer's perspective with that particular indicator. But outside of that, on our secondary dashboard, we're looking at the Conference Board Consumer Confidence Survey. What's present situations versus future expectations? Usually right before a recession, people are less optimistic about today. They're more optimistic about the future. And you can look at the University of Michigan Consumer Confidence Survey. We also have a lot of proprietary surveys that we look at from our sell-side research providers, and all of those surveys that I've seen, and there's been quite a few of them, they've seen a huge ratchet down or a hockey stick down of consumer confidence in the month of February. And the last one I'll probably mention, giving you too many different consumer sentiment areas that we look at, but the last one I think is worth mentioning is the NFIB survey, which is the marquee small business survey, which is close to record highs at this point. So we're going to look at all of them in tandem, but then we think we do pick up consumer confidence pretty well with our job sentiment indicator and the dashboard itself.
So soon after the initial announcement, let's say, from China in January, we started to see material prices fall. And obviously the main reason is that China is a very important source for demand for commodities. So almost immediately concern was expressed about supply chain issues, which also immediately kicked off that these economic problems connected to the story were going to become supply side problems. So with that, do you believe there'll be further shuffling by companies to diversify supply chains out of China, even post-trade war, because of CV?
Yes. I mean, that was already a topic of conversation, right, for a lot of U.S. companies. I think given the issues that have transpired over the last month, I think this is going to be something that's going to be on the forefront of every corporate management team going forward. Maybe not taking all of their supply chains out of China, but diversifying them away into other regions in case there's a disruption there. More importantly, I think governments are going to think about supply chain vulnerability of critical necessities. We're not talking about clothing or, maybe auto parts or something like that, but more along the lines of medicines and medical supplies, which many of them are produced in China. And if you have multiple sources, this means that if you have a disruption, you obviously can continue to get some of that supply when you need it. From a specific sector level, there are some industries that are exposed through China through both supply chains and in demand. A lot of those are going to be centered in consumer discretionary and also IT. Think automotives, obviously apparel, semiconductors, hardware. But thinking about IT specifically, IT does have outsized risks to China. The first reason is because IT generates about 15% of its sales in Greater China versus 2% for the S&P 500. So they're about 7.5 times more exposed than your average S&P 500 company. Also, 8% of your average IT company in the S&P 500 have their assets based in China versus less than 1% for the S&P 500. So long way of saying, I think IT is sold off over the course of the issues with coronavirus, and until China can come back online, I think IT is going to have a tough time moving forward. But I think supply chains are going to move closer to their end client at the end of the day. And I think with the advent of robotics, if you have robotics that are running a manufacturing plant, it doesn't matter where those robots are operating. What matters is your shipping costs to your end client. And I think this is going to be a theme that's going to play out over the next, call it 2 to 5 years where supply chains will be either diversified away from China or move back home towards their end client, which could be a net beneficiary for the U.S. overall.
Okay, I'm actually surprised it just took this long for one to come in on oil. So we've also seen oil drop significantly over the past month. Where do you see oil heading, and what are the potential impacts on the U.S. economy?
Well, yeah, oil's, unfortunately, I think in the near term going to have some tough sledding, right? Crude oil is the most oversupplied that we've seen since 2015 at about 1.5 million barrels per day, or about 1.5% of global supply. Obviously, in 2015, that sent oil prices down from $100 a barrel down to $30 a barrel. And a lot of the drop in oil was because Chinese demand growth was expected to represent about 60% of global demand. In the first quarter, demand in China is expected to be down 3 million barrels, or 3% of global demand. And this may be the first time in a very long time since the Great Financial Crisis where oil demand is down year over year, which would be only the fourth time that we've seen that since the 1970s. So there's a lot of supply out there, not a lot of demand, and unfortunately, if issues get normalized with Libya, about 1 million barrels has taken off of Libyan supply because of the civil war that's been going on there, you can have even more oil coming into the marketplace. And let's not forget, with the U.S., rig counts have been coming down. Now that crude is broke below $55 a barrel, which is where a lot of these shale producers, it's their break-even point. I think the U.S., who's been the marginal source of supply growth, a lot of that supply growth is coming offline, but the hit to demand is actually too great, even with lower supply coming to the U.S. But this is a pocket that we're looking at, because if you're going to see distressed shale operators in the U.S., that could have an economic distortion to the downside for the U.S. economy overall.